Well, oil has managed to creep its way up above $87 today. Gold's also higher. That's been helping the Toronto Stock Exchange, picking itself up after plunging to a 5-month low. Now, recovering commodity prices, of course, are helping the mining and energy shares. But the TSX is still down just over 3% since the start of the year. And our guest says there's more pain to come. We're joined from the TSX by Diana Avigdor, Head of Trading at Barometer Capital Management. Diana, thanks so much for joining us.
Thank you very much for having me.
You say one of the dynamics here is that commodity specialist managers, commodity funds are seeing redemptions, investors pulling their money out. That's forcing some managers to sell resource shares right now.
I think so, and I think that we've seen that in the foreign flows. It was on Bloomberg a couple of days ago for the data for February. Canada lost $6.1 billion in the month of February. So the Canadian market is seeing cash outflows, and that $6 billion was a net number because $11 billion outflow was out of equities only. So, some of these commodity specialist funds, both here and in the U.S. or anywhere else, are hurting, and they're down, 20-30% year to date, some of them. And so, of course, they will see cash outflows. And, so whether they want to sell their stocks, it entirely doesn't matter because they need to meet redemptions. Plus, what's been happening in the last few trading days really shatters investor confidence because really, even if you're a bear, this kind of sell-off, the violence of it, surprised even the biggest bears. Nobody expects their target to be met in 5 days. So that doesn't bring people into the market to buy until it's way, way, way oversold. And then we have a melt-up like today in the gold shares.
So Diana, when we see gains that we're seeing today in some of the energy stocks as well as the gold stocks, do you think this is a value trap?
Yeah, well, I don't know. I mean, on the gold side, a lot of the analysts are talking about the various companies' cash costs, and as gold price goes lower, some of these gold companies are not really that profitable. But yes, I think that what happens here is that the forced selling may be coming to an end, and certain fast money traders are anticipating the end of that forced selling, and they're trying to turn a quick buck. And so you see some of the buying. You also see some buying by those lucky managers that do have money to maybe add to their existing positions at a very, very cheap price. I mean, some of these gold stocks that are an RSI below 20, that's relative strength index of below 20, generally below 30, we say it's a buy and it's oversold. So people are trying to pick a little bit of bottom to make a little money. But I think that you'll see the sell side of it in the next few days. I think that as soon as people are in the money, are going to try and flip that position.
Now, Diana, I know you're a top-down investor, so how are fundamentals different from what you are seeing in the markets right now?
Well, we're top-down, so our first question is the market investable? And then if so, where? And once we've identified which sectors have relative strength, we'll drill down into the companies and the company fundamentals and so forth.
Yeah.
Is the market investable? Then it's the first question. Well, I think I'd like to, if I was to advise longer-term investors, I would say this is the time to do nothing. You want to see whether the market rebounds and that the volatility subsides a little bit. And let me be clear that we're talking about two markets here.
Yeah.
One is Canada, one is the U.S. The U.S. is in better shape than Canada, and our portfolios have been more skewed, or at least 50-50 between Canada and the U.S. For those that can do that, I think you need to diversify outside of Canada at this point.
When you see, you see this sort of rebound, when we do see it and we see some stability, like you said, a stability and volatility, what sectors would you look at, Diana? I mean, I was noticing that telcos, they seem to be bucking the trend somewhat, at least here in Canada. Do you think this is the best defensive play, or would you put your money somewhere else?
This is perfect time for those investors to do nothing and to watch what holds up. what holds up best is where you want to be, and that's how we manage our funds. What holds up? So telco holds up to a certain extent, the financials, but they've had a bit of a sell-off. Utilities, we've been talking about this theme for a long time. The rally that we had this year has been a defensive rally, really. It's been large cap, dividend paying. Yeah. We've talked about cash flow and cash flow growth, stable balance sheets and that sort of thing. Not so much the traditional beta such as energy or copper or small cap or not telcos, technology. So you've had a defensive rally, healthcare, Johnson & Johnson, 52-week high for the last month, Merck. Those are traditionally defensive sectors, and those are the ones that have worked. So it's just telling you that the investors have just barely moved away from safety into another type of safety. And I think that those are the sectors that will hold up well, hopefully, in this little correction.
Diana, looking at the TSX, I mean, is there a sign investors should look out for that will be the signal to get back into this market? I suppose near-term despair, that's what we're looking for, other investors to give up, and then it's time to get in.
Right. So I'd like to see the volatility in the commodity sector subside for Canada. 200 gold points in 5 days is too much. We'd like to see that stabilize. I'd like to see copper market volatility stabilize. Some of these sectors, look at yield support. I mean, a good healthy bank in Canada, if it goes to a 5% yield or 6% yield, that would be a buying opportunity, right?
You'd lock it in?
Yeah, I think you could dip your toe in pretty safely, despite the fact that there is some headwinds. In the U.S., it's earnings season. It's early. It's been a little sloppy, but you want to look at things that have worked, like Coca-Cola, for example. Stocks that are relatively outperforming the market, because that's what's going to take off once it's stabilized. Now, on the flip side, the longer the correction takes place, the more it's going to seep through the higher quality sectors. So you got to watch that, and I think the next few weeks is that time to watch.
Diana, we'll have to let you go. Thank you so much for joining us.
Thank you very much.
Diana Avigdor, Head of Trading at Barometer Capital Management, with a cautious measure there. Wait till the craziness stops if you're a long-term investor.